Hello everybody, Brad Beer here, BMT Tax Depreciation CEO. Welcome today. What we've got is our webinar on tax depreciation for investors. Big turnout today, which is great. What we're going to do is talk depreciation. What's it do? What's it about? It's about some cash. Let's show you a bit about how we do it and some of the tools that we've got for investors to help their job of or the journey of investing to be easy. BMT, we've been around since 1997. I've been here since 1998. We've organically grown this business to where it is today of about a little under 200 staff. Been through some interesting times over that time, and I was the first one of those. So what I'm going to do today is run you through some depreciation, talk about it. We're national spread. We do these things all over the country. Let's get into it. What is property depreciation? What it really is a hidden cash flow for investors. Buildings are getting older, they wear out. The tax office says that over time you get to claim deduction for the wear and tear of these buildings if they're used for investment purposes. I think the easiest way to kind of explain it in a way that we understand is to think of your car. If you use it for business, well, think of your car. As soon as you drive it out the door, it goes down in value or depreciates. If you use your car for business, tax office allows you to claim some of this depreciation as wear and tear against your income. With investment properties, very similar. The reason it's a little more difficult to understand is that we're buying properties with the purpose of making money, and we want them to appreciate in value. But the building itself is depreciating in value or wearing out over time, and the tax office for investors lets us claim a deduction based on the wear and tear over time. The easiest way to get in and show what difference it does make is to run a simple cash flow scenario on a property, and let's assume that we don't claim depreciation, then assume that we do claim depreciation and see what difference there is in the numbers. So let's just take a unit here. Purchased for $550,000, a brand new one. Let's say it's get some rent, which is what we're after as investors, is the money, $520 a week. That means the income for this property is going to be about just over $27,000 in the year. Now, we have some expenses we've got to pay in order to keep this property, rates, management fees, interest, etc. Let's say they're about $35,000, $35,330 in this case. What that means is in order to hold on to this property, the investor is going to need to put in $8,290 per year, or about $159 per week out of the back pocket. Not fantastic, but it does get a little bit better than that. Let's assume without depreciation, with our losses against this property, the government allows us to make a deduction for these losses. And let's assume we're on the 37% marginal tax rate, which is where most investors do sit in this country. So what we're going to have now is we've got an $8,290 loss. We're going to make a deduction for that against our other income, providing we've got other income that we can write it off against. We're going to get a refund now of $3,067. Our outlay after we make this deduction, $5,222 for the year, or about $100 a week. So this is purely claiming the expense of owning that property, the tax office allowing us to get some of this cash back. This assumes no depreciation has been claimed. So let's add depreciation into this scenario. We think on that particular property, the deductions in the first year, around $13,500, meaning our total deduction now is $21,790 for the year, providing we still have other income to write this off against. It's a deduction. Our refund now, when we do our tax return, is $8,062. Our outlay now for the year, $227, or about $4 per week. So the difference, claiming depreciation or not claiming depreciation, is $96 per week. My job on this page is that $13,500 number. We're depreciation specialists. We come in, we maximize that deduction, try to make it as much as we can and obviously legitimate. And then this property, instead of being $100 a week, costs $4 a week. I think these numbers should always be crunched on a property before you go and buy it, so you know what this is actually going to look like. The difference, one of the key differences in depreciation and that other loss is that the depreciation is a non-cash tax deduction. The $8,290, we paid it out. We had to pay for interest and all those things. The depreciation, buildings getting older and wearing out, and we're making deduction for that. So non-cash deductions make bigger differences and put more cash in yours or the investor's pockets. Now, I won't run through in as much detail here, but I've got another scenario just to show that depreciation still is available and works on not brand new properties. It's a regular question. Older properties do get some deductions. They don't get as much, depending on a whole range of things, but they still get some deductions. And we just got to ask the question and see if there's going to be any deductions in your particular property. Now, $460,000 is a purchase price, $440 a week is rent. We can see our cash putting in at the start is $3,493, or about $67 a week. Left-hand column, when we actually make a deduction for that $3,493, we end up at $42 a week as a cost. Depreciation on this one, $5,600 for the year. Not as much because it's an older property, but there's still deductions there. Our cost to own this property comes back to $2 a week, or outlay for the year, $129. $40 a week is the difference between claiming or not claiming depreciation on this property. It's an older property. The deductions aren't as much, but they still make a difference. You know, the other way to try and get an extra $40 a week is try to put the rent up $40, but it's really hard to do that when you've got to have rent within the current market. And it just doesn't, you can't just be above or you'll be vacant. Why does a quantity surveyor get involved in this? So I'm a quantity surveyor. I did a building degree. I come out as a quantity surveyor after some other work, you know, joining the ARQS and the logbooks, etc. Traditionally, a quantity surveyor measures and estimates construction costs of buildings. So we can get a set of plans and specifications. We can count the bricks for you, and we can work out what it would cost to actually get those bricks there and to actually build that building. The claims that we make relate to the construction cost of the building. So where there's not all the costs available, then the ATO will accept the estimates by a relevant professional, such as a quantity surveyor, is the wording. We're quantity surveyors, so we come up, we estimate. So what that does is cover the risk over that construction cost. On top of that, you need to specialize in knowing how to maximize the deductions. All QSs know how to estimate construction costs, but we also need to know some of the tax rules and make sure we apply all those rules to maximize those deductions. Remember, my job on that page is the $13,500 number, making that as much as we legitimately can. So knowing the rules and making sure they're actually applied. And we'll get into some of those and how they work. Look, a couple of questions to address, because they're usually always the first one, and the first one at the top, doesn't my accountant look after that? You know, when you sort of talk to people about what you do and you say you're a quantity surveyor, a depreciation person, people just think their accountant looks after all their tax affairs. Now, your accountant does look after your tax affairs. There's a whole lot of numbers on that page, and remember I said one of them comes from us. We work alongside the accountant to get that number right, to get it as high as we can legitimately get it, so that you get the most deductions from it. Most of the work we do actually comes referred by accountants. I think if your accountant's good, they should be talking to the quantity surveyor about this part of the process, because they're a general expert in tax, not a quantity surveyor that knows how to cost the building and come up with those depreciation numbers. Old property still gets it. I still get that question basically just about every day of my life. There's still deductions. It's not as much, but it's still worth asking the question. Capital improvements and repairs. If you complete capital improvements on a property, they need to be depreciated, which is what we're talking about here today. But repairs and maintenance are instant deductions. So we don't put repairs into the depreciation schedule. They're actually just claimed at 100%. We exclude them. We talk to the accountant about what to exclude and what you want excluded, or they want excluded or not at the time. When do we apply this? Well, before you buy anything, I think you should crunch the numbers. We've built an app that we'll have a little look at later in this presentation that helps you to do that. What you need in order to crunch the numbers like the ones we just did on those pages before is some sort of pre-purchase estimate of how much depreciation might be. We've got a depreciation calculator online. It's free, you can download it and use it, and it'll give you approximately the numbers in relation to the property you're looking at. You've got to put a few details in there of the age of the property and things like that, but you need to know some sort of numbers before you actually go ahead and buy something. Recouping missed deductions. If you don't pay your tax, the tax office will find you eventually and make you pay it. They'll probably give you a fine, etc. at the same time. It does work kind of the other way as well. If you haven't been claiming your deductions because you weren't aware or you thought your property was too old, you can actually go back to the tax office and you're able to amend your last 2 years of tax returns. So sometimes the tax office gives you some cash back, even after the fact. If you haven't done it, if you've got a property and you haven't got a depreciation schedule done in the past, the first thing to do is to get on the calculator online and see what sort of deductions might be there. Send us a photo or a link to the property last time you rented it. We're happy to talk about the approximate deductions that might be available. And then if there's a difference between what we think and what you're claiming, you might want to talk to us about seeing if you can get those deductions. Amend your accuse your tax returns, go back and get some money from the tax office. We have a guarantee. If we can't find deductions twice, what our fee is in the first full financial year, we'll actually give you back the money. We won't do the report. So there's a guarantee of deductions. We'll find out, see if they're there, new, old, whatever it is. If there's no deductions, we don't want to do it. New, old, or renovated property. New property we've talked about, old property we've talked about. If you renovate a property, you change what's there, and therefore you change the cost of what's there, so you change what's available to be depreciated. So if you renovate the property, you need to have a discussion about making sure you've got those things included in your depreciation schedule. Scrapping. If you're a renovator, my advice or my thoughts here are you should call the quantity surveyor before you rip it apart. Why? Because you might be throwing away things that have some value. And if you do that, the rest of the value that is left might be a deduction in the financial year. Might be a deduction in that financial year when you actually throw them away. So when you put new things in afterwards, then those things are deductible as well. But before you rip them out, just in case there's some value in them, make sure you've spoken to the quantity surveyor first. Non-residential properties. I get a regular question of, do you guys actually do commercial properties? Yes, we do. All sorts of properties. Warehouses, retail, office, restaurants, cafes, hotels, pubs, the big rocking horse in Adelaide, the Melbourne Eye in Melbourne, all these things have depreciation schedule from us. So anything that's used as an investment, yes, non-residential we can do as well. And in this situation, the owner and the tenant potentially can make claims. So the owner of the building makes some claims, and the tenant who has fit out in the building has got potential to make some claims as well. Now, so far, I've blanket called it depreciation, but a little bit of the technical on how it works here. It's actually broken up into two areas. One is what we call the building allowance. These are things that last a long time: concrete, walls, floors, and roof. Let's take an example to explain how this works. House here built in 2010 at a cost of $260,000 gets a claim each year of 2.5% of that, which is $6,500 per year from when it was built until when it runs out, which is 40 years, which is basically claiming the whole $260,000. In order to claim this, it needs to be built after a certain date in 1987. It also applies to renovations. So if you've got an old house and you or someone else adds another room, puts a new kitchen and bathroom, this 2.5% deduction does apply to the works that have been done, even though it may not apply to the original house. Now, you can only claim this when you're using it as an investment property and you own it, obviously. So you see this one here that's built in 2010. If you bought this property today, then you would have 30 years of that claim left. The first 10 years, claimed by somebody else if they used an investment property, or not if they lived in it, whatever happens, you start your date from now. But it's always that 2.5% of the original construction cost that this claim is based on. The other part, plant equipment, things like dishwashers, curtains, blinds, air conditioning systems, things that don't last as long. The tax office gives an effective life. A dishwasher, the current rules, has a life of 8 years. That means they're trying to work out how long it should last, and you're claiming it over that 8 years. Dishwasher at $1,360, it's a rate of 25% diminishing value, and the first year's claim is $340. 25% is a lot higher than 2.5%. So the more of these things that we find in your property, the better, because the more deductions we get in the early years. New rulings, a couple of changes in the last few years that they've made. They don't make a lot of changes on a highly regular basis, but one they did do recently is they went out and they looked at how long some things should last, and enacted it from July 1, 2019. It used to think that the tax office used to think the carpet lasted 10 years. Now they've decided it's got a life of 8 years. Television, microwave, dishwasher, I can see have actually changed as well. They don't make those changes very often, but we have had some changes. We've actually got all of the rates here, the effective life, on 2 apps that we've built. One called Resi Rates, one called Rate Finder. Resi Rates is all of the things in a residential property and the effective life and depreciation rate. Rate Finder, there's about 6,000 items in total, non-residential, all sorts of things. All the effective lives are in there, and we update it as the tax office does change them sometimes over time. Another little change, it's a little while ago now, but I still get a fair few questions about it, so we'll address it quickly. In 2017, the federal government changed depreciation legislation in relation to second-hand plant and equipment. What they did, a change that I don't think makes a lot of sense. I spent a lot of time in Canberra talking to politicians about this change as they were making it. And they've kind of said that second-hand plant equipment is no longer something you can claim as an investor. So new properties are the same. Second-hand properties, if your stove is 1 year old, you don't get to claim anything against that, providing you've bought after that date. It's a change that happened, and really what I'm doing here is showing some of the difference in deductions between before and after this change. New unit at $550,000, first year $11,800. Now a 2-year-old one with a similar purchase price, about $6,700. Under the old rules, the second-hand property would get second-hand values against some of those items, and its deduction wouldn't be as far away as this is. But it is the rules, it's the way they are now, so if you've bought after, we don't worry about the past, we've got to buy now. That's why you get an estimate based on today of what sort of deductions might be there, because the rules do change over time. If you've got a property you've bought after this date and you're not sure, we can still have a look, make sure there's some deductions there, the fee guarantee still exists. We just work out whether some deductions there based on whatever the rules say at the time. And if there is, we go ahead and do something. If there's not, we don't want to do any depreciation, obviously, on those, because there's no money there. How do we get the most out of it? Obviously, if we fund more plant equipment, we get more deductions earlier. More 25% things instead of 2.5% things is better. Making sure we liaise with the ATO regularly, research legislation, and the other thing is making sure that we apply all the legislation. It's pretty hard to keep the software continually making sure that all the rules are applied. It's more than just costing up a building, it's making sure we know these rules and we apply all these rules properly. The way we cost things for depreciation, sometimes you've got the actual costs, and we want to use those actual costs when they're available. Tax office likes to use those, and so do we. But the way we cost plant and equipment for the purpose of depreciation is got a bit of a different method. There's a supply, installation, sometimes consultants fees and things that relate to getting those items there, and we cost them for the purpose of depreciation accordingly. So making sure we cost it properly. Strata in common areas. Strata common areas. You own part of the common lift, underground car park, pool, or things, driveway, things in those common areas. You own a piece of them, you get to claim your piece of depreciation against those things. So we go through the common areas and make sure they're costed, divided by your strata entitlement, etc., and we get some deductions out of those. Furniture is plant and equipment. So if you furnish something, you've got furniture in there, providing it fits the right rules and dates and things like that, then there's claims as plant and equipment. process, we try to make it easy. We talk about the potential of claims in your investment property. We'll even give you an estimate up front of what we think the deductions might be for free. We arrange an inspection with your property manager. So we go out, it's a staff member every time that does this inspection. We don't employ contractors. We have staff that are trained to collect the right information on site. Since COVID, I've seen lots of ways that suddenly people seem to think we don't need to inspect a property anymore. With COVID, what we've done is we've taken all the precautions necessary. The guys have masks. We go to a house. We ask the tenant to open all the doors, turn all the lights in, so we don't touch a thing. We still want to do our inspections and jobs properly, just before COVID and now with COVID and after COVID. The AIQS put out a statement saying that maybe a quantity surveyor could visit after if it was too difficult to get in. But what that does require is someone to amend a tax return, potentially pay their accountant amend a tax return. We've been able to manage to get through most properties unless there's someone at risk. We ask all these questions, and if you do have one, take some time because there's risked people in that house, then we want to make sure that people are safe first, but we still want to do the depreciation schedules properly. So sometimes you've got to bear with us through this sort of situation, like we have with many things through the COVID drama. But an inspection is an important part of the process. It was before, it is now, and we want to get these jobs done properly. We review the drawings, conduct the searches, prepare the schedule, save you thousands of dollars is the plan. We don't send you off to the council to try and find things. If you don't know, we've got access to a lot of the data. We want to make the process nice and easy for you. Things that should be included that are important. Total cost for all the items, obviously. We project it for 40 years because that's how long the claims go for if you've got a new property. Now, we'll get into my BMT in a moment because obviously sometimes things change and we'll show what we do in those situations. We give you diminishing value, prime costs, pooling schedules, the different methods of claim. We don't have a technical enough time to go through the differences between those things today, and we won't, but you can read up on those on the website. But we give you everything. Your accountant will look at what your financial situation is and do whichever is best for you. Same with the small business enterprise rules that are in there as well. We prepare them appropriately, even with the instant write-off deductions now with up to $150,000 for the appropriate entities. We take these things into account when we prepare these reports. Split reports. If two owners own a property, the way these things should be done is to actually split the value of the asset and then apply the rates and rules. So we split them up. It creates a big long report with a lot of numbers in it, but it does sometimes give more deductions to the two than actually just claiming half of it each. So we split them up, we do that. Emails to you of a PDF copy and your accountant, we share them with the accountant. CSV, sometimes they can download them straight into their systems, Excel files. The other thing you get is free access to My BMT, which we'll get into the details of a little bit later. It's an online portal that helps you to manage your depreciation. Value adds, things that we've got there, depreciation calculators and other apps. We'll explain some of those in a moment. Newsletter Maverick, if you don't get it, you should get it. You probably get it if you're in here today, but we write some case studies in there. Is probably I think is what the best, well, I like it all, but the case studies around scrapping, around those changes, around, let's run some numbers on scenarios and different things and see what it means. And that's the place where we do a lot of those case studies. Training, understanding, really the important thing is to understand crunching your numbers at the start, what it's about. There's plenty of information on the website to help you to do that. My BMT, let's get into that. We built this portal with a couple of dreams and one of those was really that it was about access to all BMT depreciation schedules for yourself as the investor or for your accountant. So it's a portal. As soon as you get a quote for a depreciation schedule, we offer you a login to this. Now let's be clear, you don't have to use it. You can call us and email us and do all the normal ways. We're happy to work that way. This is about making it easy for you and easy for your accountant. So if you've got multiple schedules, you can see them. You can see the status of what's going on. You can get more quotes. The other thing is you can share this with your accountant. Sharing it with the accountant, and the accountant who has a login There's 100 and something thousand people have a login, if your accountant has a login and you do that, you share it with the accountant, and the accountant with one login can see all of their clients' depreciation schedules in the one place, making it really easy and hopefully cheaper for you. The other thing was about having basically a live depreciation schedule. Like I said earlier, the depreciation lasts for 40 years, but generally things get replaced sometime in that 40 years. In the past, with your hard copy depreciation schedule, we can fix that, obviously, or you give the cost to your accountant and they fix that up and they have to subtract the old carpet off and scrap it, put the new carpet in and add that. We've made in My BMT a situation where you can actually go and add these assets, remove assets, and it updates your schedules and you reshare that with your accountant, so your accountant has your new numbers as you do work in the future on that property. They were the two main dreams behind that. The other thing that we wanted to do was create an environment that had some other, I guess, cool and handy things for investors to use. So inside of My BMT, we've added some other things that are here. For example, the first one under Research and Insights is a metrics-based valuation. We've got a company that provides a lot of the valuations to the banks to actually, if you've got a BMT schedule and you're an investor, we've got that metric-based valuation sitting inside under Research and Insights in My BMT. Cost you nothing. And these ones are not available and open to the public. There is some type of those that you can, but these are done by people that actually provide some of this information to the banks that the banks do pay for. So we've been able to get access to that only for the properties that you have a depreciation schedule for. Notifications of planning applications near a property. This one has probably been the one that people like the most, almost. And you can set up a perimeter around your property, your investment property in My BMT, and as someone puts a DA in close or plans and permits in close to your property, you actually get an alert, and you can go and it'll take you to the local council site or give you some information about DAs around your property or plan applications that have been put in. I don't know about you, but I've got a few investment properties. I'm an investor, and if someone wants to put up a 40-story high-rise next door, I'd probably like to know about it. And this is the way that you can actually find that out very easy. One other thing, a new feature that we've just added is income and expenses. Hopefully none of you go to the accountant anymore with a shoebox, and we've at least got some sort of a spreadsheet instead of a shoebox of receipts. This is a way that you can enter those into the one place. It is built as per the way that the ATO's guidelines collect the information. And on top of that, when you hit the button in there, it drags your numbers in from your BMT depreciation schedule, of course, which you need in order to do this. And then you share all these numbers in one little spreadsheet to your accountant very easily, and making it really easy to do your tax return with the depreciation numbers included. Another little tool that we've built sits inside My BMT, or it's an app and open to use. Before you buy a property, I'm a big believer that we should crunch all of our numbers. We're buying properties to make money. We do that through growth over time, and we do that through the cash flow as well. Depreciation is a piece of that cash flow. I run two examples earlier on a couple of properties on what that cash flow could look like. We do lots of depreciation estimates, and then we were asked a number of times how to use that. How do we actually crunch these numbers? So we built an app so that you can do that. It's free. It's called PropCalc. You can put the address in there, and it actually drags a lot of the data around that property that we can, like the median rental and things like that. But really, you want to go and personalize that yourself. This is the app that can do that for you. Doesn't cost you anything, so you enter some information. It works on owner-occupied properties. Obviously, there's no tax piece on that, but it also works, obviously, on investment properties and drags in some depreciation if we've got enough information there. What's it look like? Gives you a little report on your cash flow, weekly, fortnightly, monthly, and you can actually download a full report that has a lot of the information about the suburb you're looking at, the census data, I think, comes in there as well, and just information to help you make informed decisions. Once you're logged in, you can actually compare the properties. So you're looking at multiple potential investment properties. You can compare some of the numbers inside this app that we've built to make it easy for investors. In addition to doing depreciation schedules, after we've done about 700,000 of them in total. One thing that we looked at and started BMT insurance business a little while ago is a lot of people don't actually have their property insured for the right amount of money. 83% is actually the figure put out by the Insurance Council of Australia. So we've actually been and estimated a construction cost for your property if you're a landlord. Your property if you've done a depreciation schedule with us. And then we became insurance brokers so we could actually compare some policies and actually use the proper reconstruction cost. So if you're interested in insurance, then BMT Insurance is a business that we own as well, run separately. Landlord cover through COVID-19. We still have options for some landlord cover since COVID. Just about all of them don't have rent default as a cover anymore. If you're renewing, you probably should stay where you are because most insurers have actually allowed you to renew that insurance and maintain that existing level of cover. But we've got an insurer who will cover landlord cover only, who will provide landlord cover with COVID-19 with rent default excluded, and they have actually also reduced the price, which a lot of insurance companies are taking something out and charging you the same amount of money. We've actually got someone who actually have reduced the price because there's a little bit less cover offered there. Always interested in discussing insurance as well. Some of the free apps we've got for investors. PropCalc we've talked about, depreciation calculator, resi rates, rate finder. We've also got a construction cost calculator. So if you're a developer and you're thinking about building something or you want to know an idea of construction costs, we publish some of those construction costs on Maverick, but we've also built an app so you can go in and do that bit of base information from the start to get yourself an idea of sort of construction costs for things you might think about building. We also have the insurance app there that has got some numbers around replacement cost. That app also free. If you're not looking, if we haven't done a depreciation schedule, you can go in there. It's a free app. Get an approximate insurance replacement cost. Now, look, that concludes our learning for the day. Hopefully, we've taught you heaps of stuff. We've got a bunch of questions. I've had someone here answering on the way through. If we haven't answered them as yet, we'll answer them within the next 24 hours. Important thing, June 30 is fast approaching. Your depreciation schedule is tax deductible. So order and pay pre-30 June and you'll get to claim it in this financial year instead of next financial year. The other key point around this is if you haven't done it properly or you haven't done it at all and you've owned that property for a period of time, you can amend 2 years of tax returns, as we said before. Don't do another one before you get it sorted out and get the money back from the tax office that you do deserve. Thanks for tuning in today. Sorry for a very slightly over time there. A lot of content. Hopefully you've all learned plenty from that and look forward to helping you out to save some of those tax dollars. Thank you.